Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler here, talking money and investing. And joined this hour, hasn't been on here in a while. I don't think he likes me anymore. Jim Wood.
You changed the lock, so he won't let me in anymore.
Changed the lock. No, I did not do that. Sometimes I should, but no, not because of you. All right. So, yeah, man, it's good to have you in here.
It's good to be here.
So I'm going to let you kind of run the hour as far as what you want to talk about. I'm just going to be here for eye candy.
All
Ear
right.
candy, I guess that is.
Well, that sounds good. Let's start out something that we talked a little bit about, the retirement bucket rule, your guide to fear-free spending.
Oh, that is a good marketing thing. That's something that the investment industry teaches young advisors. You've got the buckets that you pull money from in retirement. Yeah, go ahead, man. That sounds good.
Yeah, and this was an article from Kiplinger, which, they say that, okay, we're this magazine, this organization that's going to help people with their money.
Yeah, I'm not a big fan of any of the magazines. One of my favorite stories of magazines is the one that wanted me to do an article. And I thought, this is great, man. They want me to do an article. I'm a radio guy. They want me to do an article. And they wanted $10,000 for the article. But
Well, I was always impressed, 11 years ago now, believe it or not, when I got to Tennessee, and you had a big box of magazines that were already like 8, 9, 10 years old. And the stuff that you had kept just to go back and say, okay, this is what they were selling 10 years ago. How'd that work out?
Yeah, I'm a pack rat when it comes to that, because it's funny. They don't work out.
Yeah.
They'll tell you to do this, do that, and the other thing, and then it doesn't work.
And we put in, tons of that stuff in workshops and things like that in terms of, here's what would happen if you followed money magazines, follow these stocks every year at the beginning of the year. They have the issue that has the start of the year issue, what you should buy now or moves to make now. And what happens if you actually did that inevitably turns out to be not very pretty.
So how are they screwing up people now?
Well, let's discuss.
You like that transition?
Well, the bucket rule, and some of the people, out there might have heard of this before. It's where you just take all your money and you're dividing it up into separate buckets, and you have a short-term bucket and a medium-term bucket and a long-term bucket
and an annuity bucket.
Yeah,
that's often used.
You
take your money out of this annuity, and then that's going to be your safe money. And
Right.
then when you get later on, that bucket runs out. Then you pull money from the other bucket that is not as safe, but it grows faster, and it'll just be, Murphy's Law will kick in, and the market will happen to be down when you get to that bucket. But who cares? I mean, I sell my annuity now.
And if you're using the bucket approach, even without annuities or something like that, you're still going to have the same allocation if you put it in 3 different places. If you have X percent of fixed income, but you have it in 3 different buckets, you still have X amount of fixed income.
And you got the same problem.
Yeah, exactly. And so it's more of a psychological approach when even if done almost right, it's more psychological than doing anything actually beneficial. But
so when you say psychological, what is the impetus for doing something based on psychology in this? If it doesn't work in practice, but it works psychologically, what's the difference?
Well, it makes somebody feel safer, but they're not necessarily any safer.
That's exactly right.
Yeah.
yeah. It sells. Yeah, that's exactly
right. And that's ultimately what it is. It's a way to sell somebody on a concept when they're,
It's using your psychology against you. That's exactly right.
Yeah. How many cats are in the bag that you're buying, or a pig in a poke?
I don't know that one.
Okay, so let's talk about the first, because this article was talking about 3 buckets: short-term bucket, 1 to 2 years of spending; medium bucket, 2 to 10, and then long-term bucket, 11 years and beyond. And the short-term bucket, 1 to 2 years of spending, and this one I actually didn't have much of a problem with, because this is an approach that people sometimes will take, and it works pretty good in terms of, I have 2 years of spending in cash, so I know that whatever happens to the market, I'm going to be okay. I'm just going to spend this cash and we'll let the markets do what they want to do. And if they have proper allocation for the rest of that money, then there's nothing wrong with that.
And that's very typical for me, Jim, as well, is to have, hear the rule of thumb, have 3 to 6 months worth of spending in cash, when you're working, because a lot of disability policies have a 3-month waiting period before benefits kick in. So you might hear 3 months. 6 months might be, some policies actually go that far out, but you also have other things that can come up besides you losing your job or not being able to work. You can also have a situation where your roof goes or, car needs to be repaired or
HVAC.
Whatever. So, yeah, there you go. HVAC. It sounds like you're talking from personal experience here.
I am.
So, you might have 3 to 6 months, but it's very often I will tell people that are physically in retirement, we might go up to a year worth of spending. Now, you're saying that they said in the article 1 to 2 years. 2 is getting to be a bit high, but, you could still make the case that if it makes people feel better.
Well, that's what it is. And sometimes psychologically, again, that gets them over that hump of knowing that, doing the right thing in terms of you need some type of long-term growth in your portfolio to maintain purchasing power. And if having an extra year in a high-yield savings that's, at least keeping up with inflation, that type of thing, allows you to properly invest the rest of your assets, not necessarily a bad deal.
Yeah, sure. And we talk about what do you put it in? CDs, a lot of times people do that, and they say, well, you got a back-end surrender penalty, you have interest penalties when you get at that money. So a lot of times what Jim is saying, high-yield savings, money market accounts, those types of things, tend to be better choices for that emergency money. It's got to be liquid. When somebody says, hey, just use this annuity for that, that's not a good vehicle because of the back-end surrender penalties and the lack of liquidity in those products for that short-term money, that savings. But safe, solid, secure, don't have to worry about, you're going to keep pace with inflation, but you're not going to exceed inflation is really, if you look at the long-term return of those types of investments, you're not going to exceed inflation, historically.
Yeah, if you look at what those are paying, and normally what I will do is tell people to look at some online money markets because they're typically paying the best for that type of thing. Some people aren't comfortable getting online and doing banking, and they have to look around and see what they can get from the brick and mortars. But for that type of thing, those sometimes work pretty good. But you're exactly right in that once if you're paying any taxes at all, you earn whatever they're paying you in interest, and you pay the taxes on that. After inflation, there's not much, if anything, left over. So it's a very temporary, short-term type of thing.
But it's not meant to be high returning. But
right.
Yeah. So that's the first couple of years. And you're in agreement with that one, as I am.
Yeah, but no.
Now we get into where they get
now
really...
there's door number 2.
Now we get into the sales
The medium
mode.
bucket. Okay, this bucket of retirement spending, I'm quoting from the article, is designed to provide a stable stream of income that can keep up with inflation. Okay, that's a good goal. It shouldn't include risky investments and should offer principal protection. So he's just contradicting themselves. Who points to bond and fixed index annuities,
of course,
in areas you might want to place your assets.
The magazine is recommending this.
For 10 years.
They must not have consulted with that attorney that said that they were universally horrendous products.
And of course, it's a good idea to check with a financial advisor before choosing where your medium-term assets are invested. Well, you take this article to a typical annuity selling advisor, and he's going to love that.
Of course.
You're absolutely right. That's what we should do. I have a nice annuity over here for you.
And we've got a magazine that says that I am justified in telling you to buy this.
But really...
And ignore that attorney that's suing insurance companies that says they're universally horrendous products.
10 years is a long time for no return, and that's essentially what they're telling you to do because the return of what they're recommending here isn't any different than the return in the first bucket. So they're saying you put the short term in a high yield, get a low rate of return. Put the medium bucket in something that's likely to get a similar rate of return. So this is why I just saw this. I can't believe this article actually is recommending this.
So right on. Yeah, no, that is so right on. So, and I actually talked about this a couple of weeks ago, where I was actually looking at the returns of these products and actually taking that to task. And that was the problem. You're looking at these and they're promising you're going to give you some market exposure, but because of the expenses and because of the caps that they put on returns, what they found in the research was that your returns weren't any better than any of those short-term investment vehicles. So dead on right. Yeah, exactly.
Yeah, I wish that there were rules about disclosing actual client returns.
Oh, boy.
I mean, I know we've talked many times about the global investment performance standards returns that we have available and that tell you exactly what the investors with, certain RIAs, registered investment advisors and stuff have gotten. Doesn't exist in the insurance world.
Right.
They will cherry pick to show an illustration. They'll cherry pick the best funds from the past or one contract that did really well.
The word you like to use is weasel words.
Yeah. Yeah.
So explain to people what weasel words
are.
Well,
weasel word is just something where it sounds good, but you're not saying anything.
Yeah. You could potentially have this. This could happen. You might have this. There's a possibility of this happening. Right.
There's no ceiling to the price of gold.
Yeah. Right.
Technically, that's true.
Yeah, that is true.
That was from a video that we've shown from time to time where a guy just is propping up gold, and so he throws that out, which it sounds really good, but there's no ceiling to the price of bricks
or Beanie Babies. But there was, some idiot could pay a whole lot of money for a Beanie Baby, but not likely. But yeah, okay.
Okay, so that's the medium bucket. And so what should the medium bucket really be? Well, I think that's where you're back into your properly diversified portfolio based on how you're spending the money. Are you taking income from this? Are you taking any big goals down the road? All those things that matter.
I think the second thing is, like what you just said, is so right for me, because I look at a financial plan as having a base of your short-term savings, your short-term emergency fund, and that's all very, very safe. The second layer of a financial plan is going to be intermediate goals. Like you're buying a vacation at some point in the future, or you're buying a car, and you might have an intermediate bucket that is safe in that it has a time horizon. The portfolio has a time horizon which is commensurate with when you're going to spend all this money. So, for example, let's say I have 3 to 5 years, I'm going to be going to Aruba, or where I'm going to be, buying a new car, or I'm going to be buying some big ticket item. I might have an investment portfolio that is designed for that time horizon, where that portfolio, I could liquidate it completely in that period of time, and the likelihood of my having lost money over that period of time is very, very low based on historical standards, and that my likelihood is that I would have outpaced inflation during that period of time. So that's time horizon investing, and that's what I would say might be intermediate, but that's not what they're saying.
No, not at all.
Not at all.
And that's what you're talking about is putting yourself in the best position with the highest probability of the desired outcome. Mm-hmm. That's math. That makes sense. That's how to do this. Yeah. But sometimes, as Barbie once said.
I knew you were going to go there. I knew math is hard.
Math is hard.
I knew you were going to say that.
And so it sounds, you get away from that and you get over to the fear side to where, well, this is where you're safe, you're protected.
Right.
But you're not protected from things going up. Every time you go to the grocery store, the beef's more expensive.
Right.
Everything's more expensive.
And you are protected from your portfolio going up, though.
Yeah.
You're very well protected against that.
You're just going to go on a forced diet. Okay, you ready for bucket number 3?
Yeah, man. Let's okay, bucket number 3.
Okay, so this is where your growth assets will stay. Again, quoting, the money will be invested more aggressively in the stock market with a ratio of approximately 70% stocks and 30% bonds. This is 11 years and beyond.
Okay.
So to me, we talk about our portfolios in terms of our aggressive growth portfolio has a time horizon of 10 years or more. Mm-hmm. And so they're already saying short-term bucket, fixed. Mm-hmm. Medium-term bucket, fixed. Mm-hmm. And so now they're also taking 30% of the long-term bucket and going fixed.
Yeah, exactly.
So what you're going to get here is
it's better than all stocks. I mean, that I'm going to give them props that it's an improvement over some of what I've seen where it's all stocks at that particular point, but still 30%.
Yeah. Well, to me, I'm more pro for something that's 10 years or longer for that particular part. If I was separating this, which I wouldn't do in the first place, I would want that bucket to be mostly stocks, much more than 70%. The reason being is because, again, it's time frame. You don't have any equities in any of that other stuff. You need that growth long term to maintain your spending.
Right. But the problem that you run into in this particular instance is that if you've gone and spent down the first two buckets, and then it's 10 years later and the stock market drops, then you don't have anything.
Yeah, okay. I guess we're looking at it from I do, and I'm thinking that you don't necessarily, what I'm saying, I guess, is you adjust this over time. That's what I'm thinking. Like you're exactly right.
Or combine one and two.
Month 12 of year 9 and we get a 20% drop in the stock market, then that's a bad deal.
Yeah.
But certainly I would say starting that bucket out long term while you have all this other stuff in fixed, you would want almost all stocks.
Yeah, and I agree. And where you're coming from, and this is just nuanced, I think where you're coming from, Jim, and it's exactly right. What you're doing is saying, no, hey, look, bucket 1's its own deal. Bucket 2 is just like bucket 1. And is what they're saying. You're saying that bucket 2, which is the intermediate bucket, isn't going to likely have any higher return than bucket 1. So that's stupid to have those two separated. But it might make sense to actually combine bucket 2 and bucket 3 and just have one thing that does all of that. But certainly not an index annuity, because you've got a problem on your hands when you're managing a portfolio. And that problem is that when I need money and I need to rebalance, everybody's heard the term rebalance. Rebalance just means you take a portfolio that starts off at a certain percentage, let's say 60% stocks, 40% bonds, and when it becomes 65% stocks and 35% bonds, you sell some of the stocks, you buy some of the bonds, you bring the bonds back up to 40, the stocks down to 60 again, you rebalance it back to the original asset allocation. Or, on the other hand, if stocks go down to, let's say, 55% and the bonds are now at 45%, you sell some of the bonds and buy some of the stocks. The problem is when you're doing what they're telling you to do here, you have locked up and you are illiquid in your bond portfolio, your fixed portfolio. Bucket number 2 in this example, you don't have the liquidity because the back-end surrender penalties of these products. And you can't manage a portfolio based on what scads of academic research say you should be doing with your portfolio.
Yeah, and to your point, the rebalancing there is impossible because you have that, a separate bucket. I'm not going to touch it, mix this bucket and this bucket. So why, and if you look at it on paper, then you can have these 3 buckets, or you can have a properly allocated portfolio with the exact same amounts of bonds, the exact same amounts of stocks. But if you're saying, well, one's in this bucket and one's in this bucket, and I'm not going to rebalance them, then you're already creating problems for yourself.
And there's a major problem that you have created for the financial advisor. They can't sell these products if you don't fall for what they're saying. If you're listening what we're saying here, you have basically taken away a huge sales opportunity. And that's our job, quite frankly.
And that's really where I was coming from, where we kind of differed on that one point, is because I'm thinking of a portfolio that you're constantly adjusting.
That's right.
You're rebalancing.
That's right.
You're selling stocks when they're high. You're selling, you're buying stocks when they're low. That type of thing. So if you were just absolutely, okay, I can't touch this bucket for 10 years, then you might not want that in all stocks because of your point. But I guess my mindset is just so dialed into, well, this is an ongoing, dynamic process. So.
No, and you're exactly right. Yeah, we weren't differing really.
Yeah, no, I know. I just wanted to clarify that.
Yeah. So that's the issue. And look at this, and here's kind of the bow on this whole thing. You read magazines. You look for these places that you get information to be objective in some way, and recognize that where they get their information is typically the investment industry. I can't tell you how many times that Jim, myself, all of us have been called up and say, hey, we've got this article we're writing. What do you guys think about this? I used to answer those calls all the time from people in the media saying, hey, what do you think? Do you want to kick in? And they actually teach you to do that in the financial world. They teach you to get a relationship with somebody in the media because they need stories and they want to write about things, and you can be a source for them. And often they don't have a clue when the media doesn't have a clue. That is, the reporter does not have a clue, or the writer, when they are being sold a bill of goods as well. You can't go and blindly trust these people to know what they're talking about either, number one. Number two, recognize that the media, where do they get their money? They get it from advertising revenue. They get it from the people that they're interviewing, advertising in their magazines, and therefore they have a built-up conflict in that they're getting information from the people that are selling stuff, and they don't recognize that the information is conflicted. Big problem. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money. And rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, there are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, so what else? What do you got, Jim?
Well, let's beat up on another magazine.
Oh, let's do it.
Okay, this is online, insurancenews.net, and why many facing retirement no longer believe in retiring at 65.
Did we ever? Well, you had Social Security age was 65 at one point in time. I guess that what might have locked that particular age in some people's minds.
Right, and that's kind of what this article in general is doing, and we'll address a couple of these, is that it's just saying that people are differing from this generic rule of thumb, which that's just normal, right? Not everybody's going to follow. Not everybody's life is exactly tuned in to retire at 65. And
some retire earlier, some later.
Some earlier, some later, and just where the whole idea of this, that it's just somebody's goal anymore. Everybody's different. More and more people I talk to seem to want to get out early.
Some people are phased. Yeah. So some people want to get out early because their body breaks down. They can't do the work that they used to do. Like, example of nurses or construction people or people
physical
that can't
jobs,
do physical jobs for sure.
And there are the flip side of that coin. I have people say, I'm never going to retire.
Oh, yeah, I have the same thing. Yeah. I think that's a little bit delusional, because sometimes what ends up happening is that their mind doesn't necessarily keep up and they can't continue to work forever, or their priorities change.
Right. And so just the idea that, this is kind of a one-size-fits-all rule starts to fall apart, and especially with this one. But it took that idea of these generic rules of thumb and started talking about some other generic rules of thumb. And I thought that's really what I thought was interesting in bringing up about this. So the first one they talk about, the norms and strategies include the 4% rule. And the 4% rule is retirement rule that is like you can basically take income at the amount of 4% a year out of your portfolio.
Got $1 million, you take 40,000 out, and you can increase it each year for inflation. Yeah. If you do everything, you got to dot the I's and cross the T's, but you can do that historically. Yeah.
And so it says more than a third of pre-retirees do not find the 4% rule to be a relevant retirement rule of thumb in today's economic environment.
I'd say it'd probably be even higher than that, because they screwed up. They didn't implement it properly. That's why I said you got to dot the I and cross the T. They don't implement it properly, and therefore it ends up blowing up on them. But
right.
And then it's not the investment world's or the investment vehicle's fault. It's the way people implement investing. But story for another time.
And when that will come up, definitely I have that included in retirement income conversations with people, and I will tell them, well, this is kind of the long-term rule of thumb, and it's maybe a good place to start the conversation. But especially with the income planning software that we work with, it almost never is 4% isn't what that spits out in terms of what's a likely sustainable income over your lifetime that, with the focus on never running out of money, but also spending as much as you reasonably can now.
Higher or lower?
Higher.
Yeah, I just wanted you to say that. Go ahead.
Yeah, and so what happens at 4%? What happens is people do that and they die with a lot of money. They make their kids happy, but they leave a lot of life on the table.
And I wanted you to say that out loud because I think that surprises people. Sure.
Right. And so I'll move on to the next one. 100 minus age is how much stocks you should have.
Yeah, John Bogle. Yeah, great. Terrible rule of thumb. You end up with way too much in bonds.
Right. Age 50, I should only have half of my in stocks. That is just nonsense. I mean, it just... Yeah.
And the research doesn't bear it out. But it was, founder of Vanguard actually threw that out there and it caught on with people, especially, in the financial industry. And I just shake my head and go, it's terrible. It's not backed up by the academic research.
And then... on that, how about the magic numbers? So people think of it references two magic numbers, actually. One is that the idea of I'm going to have X amount of dollars at retirement and then I'll be okay. Mm-hmm. I ask that question a lot sometimes. It's just like, well, did you ever have a figure in mind that when you got to this stage that if you had X amount of dollars, you'd be okay? Mm-hmm. I would say about 30% of the people actually had that number in mind, something like that. But then when I get that number, is it realistic? Is it too high? Is it too low? Can you take the lifestyle you want out of that? So there's just got to be a lot more planning behind that type of thing. And just saying, well, I'll be okay if I have $1 million. Okay, well, can you be okay if you have $40,000 a year, growing with inflation, plus, Social Security, whatever other assets you have.
Sure. Where did the number come from? Yeah, and there are magazines sometimes they'll put out things like that, and it's a very popular article topic. How much money do you need? And the number changes all the time, but people don't really have, because a lot of times these financial planning software programs, I had one that was kicked out by an employer plan, huge mutual fund company that everybody would know. And they said, this is how much income you can take from your investment portfolio. And I said, the number is way off. The number is way off based on your situation. But it was a generic number that was kicked out by the financial planning software. So I think that's where some of this comes from. How much money do you need? And the problem with these software programs, it's garbage in, garbage out. They don't know your entire financial picture. So for them to come up with a number on what is right for you would be way off. They don't know your tax picture. They don't know your life expectancies. They don't know necessarily, what life expectancy, joint life expectancy between you and a spouse, what other benefits you have access to. And hence, what ends up happening, they don't know the standard deviation of the portfolio, or they have the wrong standard deviation, which is the risk level of the portfolio. What happens, people too often, when planning for the future and investing, think about the return. What's the expected return of my portfolio? But they ignore the amount of volatility, which can significantly change the amount of income you can take from a portfolio. And they too often, they don't look at that, the level of diversification you actually have actually spits out a number that would be completely wrong based on what reality, and historical reality might have. So those are two things, garbage in, garbage out. I don't like these software programs for that reason.
Yeah. And a lot of the software programs, too, especially from particular companies, are more focused on assets not being volatile so the money leaves, as opposed to actual what's the academic evidence state about how you should take income in the first place.
So true. And not benchmarking your portfolio to see if you're keeping up. That's a big thing. If you found out you should have had a much higher rate of return than you've gotten, you'd leave. So we don't benchmark it. We don't want to look at what you should have had. Good stuff. Listening to the Investor Coaching Show right here on Super Talk 99.7 WTN. Paul Winkler along with Jim Wood. And I know you got something interesting coming up. What is that, your next topic?
Well, we're going to talk about being optimistic.
Okay, cool. That sounds like fun stuff. Why be optimistic about the stock market? Or why it's rational to be optimistic about, investing?
Yes.
Cool. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.